Welcome everybody. This is the Thursday evening Viper trading webinar. We are all here to discuss and learn how to use the Viper indicators to trade. So you're absolutely in the right place. Let's go ahead and kick off tonight's webinar. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. Okay, so here's the deal. Let's get over to some charts. And what I want to do is would like to start this webinar tonight off a little bit different for everybody who is completely new and visiting us. We have a 2-week what's called winter open house, where we invite everybody to come visit and kick the tires. Full immersion Viper experience. You get to come in the live room and see trade calls. You get all the training webinars, and of course some of you or most or all of you are taking a free trial of the indicators and Object Trader. So let me just back up and explain what you're looking at here. When you come into the trading room, you're going to see a chart that pretty much looks like this. And these are all of our indicators. Let me just turn this predictor off for a second here. And let me back up even just 1 second. For you members that are seasoned veterans, just hang with me for a couple of 5 minutes while I give a quick sort of overview to everyone visiting us here. So we here at Viper trade the futures markets on an intraday basis. So just to be clear, so we're all on the same page, this is not, long-term investing. This is not like pension type things, so it's complete. You're not buying stocks or anything here. You're not buying Apple and holding it forever. It's not like that. That's not the kind of trading we do. What we do is there are certain times that we like to trade the futures markets, and the whole notion is to generate income from that trading each and every day. So when we come to the end of the trading day, we're flat. I don't think in many years, I've ever carried an overnight position. For me personally, there's just too much risk in that, too much news risk. You go in long expecting a big bounce on some good news or whatever. News isn't what you think. Gaps down, you're in the hole, and you're, margin problems and all manner of things like that. So we don't hold overnight positions. It's strictly intraday. In the live trading room, there are a number of different instruments that you can trade. Okay, the 6 series of instruments, this is all currency futures here, and we'll look at some of these tonight. Okay, we have crude oil in the room. Gary pretty heavily trades that. He opens at the pit open on this one. It's $10 a tick. So you're going to hear me say this a lot, and I'm going to say it in particular tonight, but I won't beat it too much. Instrument selection is critical and key to your success. That's for everybody in here tonight, everybody downloading this recording, and everybody listening to this. I cannot emphasize enough. You can have all these indicators down. You can know trades like the back of your hands. You can recite mid-band, KISS trades, all sorts of stuff like that. But if you pick the wrong instrument and you get your keister butt handed to you every day, it's because you might be trading the wrong instrument. Okay? And so what we strongly urge you to do as you learn this and get into your trading future and your career is experiment with these different instruments. So in the room, of course, we have crude oil, and that's $10 a tick. We have NASDAQ, $5 a tick. All these equities, NQ, YM, and the Russell, TF, which is also in the room, this is $10 a tick. YM, as you know, and NASI, NQ, are $5 a tick. Now, these are all December expiration dates. See the December date on it? In the 3rd month of December, we're going to roll to the March contract. Okay, just a heads up there. So about another, I don't know what that is, 5-6 weeks roughly. In that vein, futures are somewhat like options in the fact that they have expiration dates and they roll every quarter. Now, some of these commodities down here, they have different roll dates. Okay, so they're not all correspondent to that. I'm referring strictly to the equities and to crude. All right, so that's an overview of the futures instruments. Now, what you're looking at on the chart here, of course, is we have a data feed from your broker, and that data is coming into this chart, and we trade 4 range charts. We have for many years. We haven't changed that. And you very prominently on the chart here, you can see that we have background colors, green and red and transitional. right? We have bar colors, yellow, blue, and red. And this is all our software. This is all Viper Trading software that's painting all this. So it's taking the data coming in from the data stream from the broker, and it's painting this onto your chart. So that's what our indicators are. The most prominent feature, of course, on here is the bands. We have the thick one in the middle. Everybody knows, of course, that's the mid band. We have 1, 2, 3, 4 outer bands. This is the outermost band. Depending on the trade, sometimes you might hear the outermost band referred to as phantom. So if you hear phantom, it's normally referring to either the upper or lower outermost band. That's what that is. That's a phantom trade. That means that it's coming to an outermost band. Okay, that's synonymous with that. Can everybody see the chart? See my cursor? I see some more people coming in. Welcome, welcome. Hey, Clark. James, good to see you. More people coming in. Welcome. We're still just kind of getting started. We're going over the indicators and what you're looking at on the chart so everybody is clear as to what they're seeing. We have this stealth line. This is an old kind of legacy thing we had from many years ago. We use it more for sort of a trailing stop right now, not so much as a trend indicator, but more of a trailing stop, the stealth line. And then, of course, we have the predictors. And you can toggle those on and off. Show predictors, hide predictors. Show predictors, hide predictors. Predictors are more or less projecting out into the future to show support and resistance levels. We can use those both to take trade entries and for targets. You can toggle them on and off depending on whether you want to see them or not. Now, well, we don't necessarily, a question coming in from James real quick here. I don't have the lightning lines on this one particularly here, Clark. I know Gary uses them pretty heavily. I use them sometimes. On this particular chart I have loaded for the webinar, I unfortunately don't have them on here, so we'll have to pick that up another time. But I think there's another question here. Do we use the opening high-low? We don't necessarily use the opening high-low, but here's what we do, James. It's a good, timely question because I was just about to show that. All right, so the first thing we do when you're looking at getting into a market open, whether it be the European session, the Asian session, the equity market opens. All right, so we look at the pre-market here. 6:30 is right here. So here's the open. Here's the open of the market. Now, here, I want to pause for 1 second here. I want to pause and take a step back for 1 second, and it's really important that I say this. There are several things that are going to be important to your long-term success in trading. The first one, for those of you that came in late, instrument selection. You have to find an instrument that you can get in that its price action is very attuned, if you will, to your style of trading. If you've been watching these markets, you see that some deeply retrace, some respect swing lines better than others. Sometimes markets push further. NASDAQ's notorious for that. Gold sometimes too. It'll go a little further than you expected, or it'll pull back deeper than you expected. Now look, if your trading style fits with that price action on that particular instant, using NASDAQ as an example, by all means trade that instrument. If you find that the way the price is moving, you seem to get in at the wrong time, or you're constantly getting stopped out, or you think it's going to hit a target and it never does, and then it comes back and you lose money, then I'm just telling you straight up, look at other instruments. That instrument you're trading might not be for you. Just because you're seeing somebody in the room make money trading crude oil does not mean that you should trade crude oil. Okay? The key is for you to be attuned to the instrument that's going to make you money. We have a lot of traders, just not as a separate side note here, who come into the room and listen to our trade calls, but they're trading other things. They're trading ES. YM is a good proxy for ES. In other words, when ES is going up, so is YM normally, because this is the E-mini S&P futures, and the YM is the Dow futures. Okay, so they're very close to each other. So what I'm saying, just to be clear and explicit about this, is that you can listen to YM calls, and normally it's pretty close to ES for those of you that trade. We have a lot of ES traders in the room. Some people trade gold. You can be in the live room trading gold on a separate chart. We have traders that trade some of these currencies in the morning, 6A, 6S, 6B. You hear them in the room all the time. So what I'm saying here is just if you have multiple screens, you can put these other instruments and watch them because the trading methodology is all the same. All the indicators are the same. The only difference is going to be your price action. Here's a comment from Clark here, and asking about ZB. Talks about ZB and ES. Okay, so he trades ZB. This is the bond futures. Okay, and ES, the E-mini futures. These are 12.50 a tick, so they're a little pricey, and ES can be range bound quite a bit. So if you're going to trade ES, just a straight up heads up, you're going to want to be really good at range bound trading because it spends a lot of time in ranges. All right, back to the open here. So the second thing I want to point out in terms of your success, other than instrument selection, is going to be having a routine. All right? Where I've seen over the years, and I was plagued with this issue myself starting off trading 20 years ago, I didn't have a lot of discipline. Okay? Truth be told, I'll just say it, 20 years ago when I started trading, I didn't have a lot of discipline. And I lost money. One thing I was consistent at, I was losing money. I was pretty good at it. I got really good at it because I blew through a lot of money. And the thing is that I didn't take the time to do something simple like this. I put a chart here at the resistance areas on the instrument I'm trading and put a line at support right in here. See those two lines? Now I think we would all agree that as long as this market stayed within the confines of this area here, that we are in a range, yes? Would we all agree that? We pretty much stay within this area right here, we're going to be in a range. And some markets do that. I mean, you could find markets an entire morning stuck in a range, yes? So this is really important to know. And how long did it take for us to do that? This is the discipline things that I'm talking about here. This is the discipline things that I'm telling you about. You should have a routine. Every morning I put my charts up. I see what the pre-market session looks like. I put my lines, support and resistance on the chart, and then I prepare to trade the morning, right? You should have a set time that you get up. You should have a set, type of trade that you like to take. Anyway, moving on. So here comes 6:30 right here. I'm here in California, so this is all Pacific time down here. Coming into this morning on NASDAQ. And let's just do a quick recap so we're all clear about what is happening on this market. The beginning of the European session is midnight Pacific time, so that's right about here. So I'm going to go all the way back and I'm going to walk us into where we're at right now as far as the opening is concerned. Coming into the European session, NASDAQ was pretty range bound. I think we would agree, yes? Like this. Chopping around midnight, overnight, European trading session. And we get a pop-up. Through that, we come up to here. We do a little chopping around. Now, right in this area right here, around 3 to 4 o'clock in the morning, as far as 5 o'clock, from 3 to 5 o'clock, what's something that jumps out on you in the chart? I'm just going to get some feedback from the team. From about here to about here, what is something notable on the chart that jumps out at you? This area right here. I'm circling with my cursor. What's something that visually jumps off the chart to you that I use all the time when I'm kind of trying to assess what a market's doing? My circle, right from 3 a.m. roughly to about 5. What can you see? What is of particular note in this area right here? Anybody? The background is pinstripes. Yes. The chart is the background is changing colors. It's a striped rainbow background. What does that mean? What does it mean when you have these kind of pinstripes on your background as it contrasted to a solid color where it's like solid green or solid red for an extended period of time? You're kind of trending up, but it's in a very choppy manner, yes? Would we agree to that? I mean, just visually you could look here and you could say to yourself, well, Charles, I know it's kind of choppy, but you are getting a series of higher lows and higher highs. So the trend is up, albeit choppy. Yeah, so it pokes up, it consolidates. pushes up, consolidates, pulls back. And so now going into the open, we are in this range right here. Now, going in, now I'm going to say this in two ways, and I'm going to do it as best I can without trying to be confusing. So if I say it and you're confused, ask me to clarify it. What would be the bias going into the open based on what you see trading this range right now? Is the bias up, down, or sideways? U for up, D for down, S for sideways. What is your bias? The market opens in 3 minutes. So tomorrow morning at 6:27 on NASDAQ, your chart looks exactly the same as this. What is your bias? Sideways to up. Sideways to up. Now that's partially a trick question. And I'm going to get back to some folks that were asking this question earlier, and I'm going to explain this in a minute. It is okay to have a bias going into the open in regards to the early trades that are taken. However, we need to be attuned to the fact that in the first hour of trading, the markets can change trends very quickly, and we need to be able to quickly adapt to that. This isn't later in the morning when the market's kind of settled into a groove and it's grinding its way up 100 ticks, and we can clearly see nice pullbacks to get in. We'll look at those so you know the difference between them, okay? But shortly after the open in the first hour, till I'd say 7:30, 8 o'clock, about when we're closing up the room, we need to be flexible and let the market go both ways. All right, here comes 6:30. So when we say bias to up, I just want to clarify something very quickly before we move on. What we're saying here is that in the range, if your bias is up to sideways and the background is green and you're still getting slightly higher lows and higher highs, then you are buying support, right? Buying support. When markets come into a support, you buy it, and the markets get up into resistance, we're doing what? Taking our profits. Exactly. If you're going to trade this range, the bias is sideways to up, so we're buying support, taking profits. In other words, the other option would be, in terms of the range-bound trading, you're shorting the top if the bias was down, yes, and you're buying it back, covering at the bottom. In some instances where you have a well-defined larger range, it's possible to trade both sides, right? You could buy support here, right? Get up here, get out of your long trade, flip, take the short, cover down here, right? Flip, get long. You get the idea. Repeat, 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 repeat. Now, in the case where you are trading both sides of a range-bound market, what's going to eventually happen? Is the market going to stay in this range forever? Is it just forever going to go on like this? Just all the way through the entire morning to the close? What eventually is going to happen here to these markets that are range bound like this? What eventually happens? They break out. They break down. They break one way or the other, Pervez. That's right, exactly. Doug and Tom and Mark. Yeah, that's right. Eventually they break. They're going to go one direction or another. They can't, there's some equilibrium here. The buyers and the sellers are more or less equal. That's why these consolidation patches occur. There's not one force that's in charge. And so what I'm telling you, and the reason I'm telling you this, is that if you're trading both sides of a range, if you're shorting the top and buying the bottom, shorting the top, buying the bottom, when it eventually breaks, you will probably take a stop out. All right, here's 6:30 coming up. Enough about the range. We all know we're in a range. Let's move on. We come up to the top of the range, and now what happens? We break to the upside. So for all of those of you who were buying down here, our suggestion in this scenario is as follows. You're buying, let me just put it real clear down here. So you're buying support. So you're getting long down here at support. And our suggestion, and the suggestion from everyone in here tonight from the team, was that we're not shorting the top. Okay, we're not taking those shorts. We're buying support down here. So you would already be long by the time you got up into here, theoretically off of support, right? The reason that we suggest to everybody who wants to get involved with futures trading to trade a minimum of two contracts if you can is that you always want to try to get a scalper. A scalper is a term that refers to a short-term target, a target that's relatively close that you can quickly bank profits on. So when you're buying support down here, getting long, we're boxing it in. We're using our line or ray tools from Object Trader. Whatever manner of tools you're using for your method of entry, you're buying down here, boxing it. Our initial stop, Object Trader places it whatever your default setting is. If it's 10 or 12 ticks, you're filled long on one of these bars here. Your initial stop is down here. Everyone who uses Object Trader needs to set the break-even plus minus to trigger once your scalper target is hit. Let's say theoretically it was right here. Once that scalper target is hit at resistance, you take your initial stop from 10 or 12 ticks down here, wherever it's sitting, and it will automatically move it within the offset to your entry. So let's say it was, I don't know, 2 or 3 ticks. So wherever you were filled long here, it will automatically take it from down here and place it up here. That's really important because if it ever flips in your face, you want to get out with a winning trade. The second contract, for those of you who trade two contracts, is always going to be the runner. The reason we do that is that eventually, in the case here where it broke out to the upside, you did in fact get a long runner like such. And then in terms of the trailing stops, I'm not going to get too mired down in that. I didn't get too deep into all the mechanics of this. I think it's critical in the beginning stages that you try to see the entries as best you can. You can work out the mechanics of the trailing stops and all those other kinds of things a little bit more down the road. If you can nail good entries, I'm telling you, that's a huge chunk of the problem right there. You're on top of a big part of the challenge. Now here we have a good question from OJ, and I want to speak to this because it came up in the live room. And Carl, hang tight. I'm going to answer your question too. The question is, what if you have a small to modest size account, say $5,000 or less? We get this question a lot, okay? First of all, it comes down to risk. Let's talk about, we're going to pause and hit the pause button and talk temporarily about risk. When you take a trade, the initial stop loss that you have, let's use round numbers, and let's just put it right on the chart so we're all very crystal clear about this because this comes up all the time. Your initial risk, I do this all the time, initial risk is established by the size of your initial stop times the tick size, the dollars per tick, right? Times how many contracts you have on. That's called times number of contracts. So let's quickly do the math. And we don't normally talk about this too much, but I think it's important we pause and do this because there's a lot of questions about where the stop is, how big is the stop, and what does the stop mean, and what if I have a smaller mid-size account? How do I define all this? I'll just use some examples here. In the case of NQ and YM, those are $5 a tick instruments, right? We said that earlier, right? $5 a tick. So if you use one contract, let's just call it one lot, times a 12 tick stop, how much money are you risking? NASDAQ and YM, one contract, We know that those instruments are worth $5 per tick of movement, and your initial stop is 12 ticks. So when you enter this trade long, right here out of this box, out of support, wherever it's entered, and your initial stop is sitting down here, if the market rolls over and takes that out, how much money do you lose? Essentially, we're defining your risk here, right? This is the risk that is on the trade when you initially take it. And we're not talking about what happens afterwards. This is the initial risk. You get in a wrong spot, whatever reason, the thing rolls over, some news comes in, whatever it happens. Boom, your stop's taken out. 60 bucks. Right. Now, if you do 2 contracts, what's the risk there? Same trade, same setup, only now you're putting on 2 contracts. What is now your risk for this trade? Right, you doubled it, 120. I'm using this as a rule of thumb, okay? I mean, the fact of the matter, it could be, let's just put some numbers in here. Say it was a 10-tick stop. So, okay, you're risking between, 50 and 60 bucks. You get the idea. This is something that you can almost do on the top of your head. You don't really need to, I mean, you can do some calculations on paper and you can sort of figure this out for yourself. 2 contracts, you're risking twice that amount. So if you had a modest size account, under $5,000, let's say you have a nominal amount, you're just trading maybe $2,000 or $2,500 or somewhere in that neighborhood. If you got a full stop out for $120 on 2 contracts, are you comfortable with that, yes or no? You picked the wrong spot. For whatever reason, you got in a bad trade, it rolls over and it takes you out. Are you comfortable with 60 or 120? Go ahead, type it in. You're going to get a loss. Okay, losses are going to happen. That's the one thing that I find all the time that's consistent about traders in all the years, is that traders say, well, I should be winning all the time. Why am I taking losses? Why am I losing? How come I am losing? I'm taking all these hits. What's up? And then they start getting all freaked out because they see their account draining down. Plus commission. Okay, I see numbers coming in. Some of you are comfortable with 60, some of you are comfortable with 120. Now, what I'm about to tell you is huge, and this is another important thing, okay? If you are not comfortable with the risk that you're putting on this trade, then you should not take it. All right, let's extend this thinking on one more thing, and then we'll move on. Let's say hypothetically you're trading a different instrument. Let's say that you're trading crude oil or the Russell. Now those are $10 tick instruments, right? So let's quickly do the math. So a 10 to 12 tick stop for 1 contract on NASI and oil, what's your loss there? It's double. You're looking at losing $100 to $120 now, right? On a $10 tick instrument. Now let's say you're trading 2 contracts. Your losses would be double, yes? You're looking at losing anywhere from 200 to 240 per initial stop out. How many of you, show of hands, are comfortable with those size losses on your smaller account? Okay, 1 contract, $100 to $120. 2 contracts, $200 to $240 initial stop loss. Are you comfortable with that? Let's do some math. So if you had a $2,500 account and you put on a 2 contract trade on crude oil or the Russell at $10 a tick, and you took a full stop out 2 contracts on 12 ticks, losing $240, how much of your account did you lose on 1 trade? How much? Almost 10%. Losing 10% of your trading account on one trade, is that prudent risk management in your judgment? Anybody here tonight, is that acceptable and prudent risk management for a smaller trading account? What do you think? Losing $200 to $250 on one trade with a nominal sized account under 5K? No, not even close. It's got to be 3.5% or less. Yeah, ideally you wouldn't risk more than 1 or 2% max an entire day. And ideally you want to be able to leave enough wiggle room to take at least 2 losses before you have a winner. So not only have you blown 10% of your account up, you don't have any wiggle room to take any more trades. 10% of your account's gone in one shot. Boom, gone. All right, so I think you can pretty quickly see that if you have a nominal sized account, even with 1 or 2 contracts, you probably should not be trading the $10 risk instruments. Okay, they're just they're flat out too risky for you. They just are. I mean, you really should have a much larger contract, 10K or above, to be taking 1 or 2 lot trades on crude oil or Russell at $10 a tick. Excuse me. Everybody on board with that? So just to wrap this up in a bow so we're all on the same page, the amount of risk that you can take in trading these futures markets is directly correlated to the size of your trading account and the skills that you have. Okay, if you're brand new and you have a nominally sized account, you probably shouldn't be looking at the $10 instruments. Okay, they're just too risky for you right now. That's not to say you're never going to trade these. You can watch them and play with them in sim, get a feel for them, and eventually, you know, when you build a little bit of your account up, you can start to dabble over here. But in the beginning, I think you want to stick with the $5 instruments. They're much lower risk. You can take a hit or two and still not wipe your account out, right? That you can recover from. Proper risk management is key and critical. Right behind instrument selection, risk management, proper risk management. Because you know what, in the beginning you're going to take stop outs. They're going to be losses. You got to be able to. That's why I asked that question. If this thing rolled over and took your stop out and blew through it and you lost, I don't know, 60, 50, 60, or even $100, $120, you have to be okay with that. Because if you say I can't even take that much risk, then it's going to be very difficult for you to trade, and you're going to be what's called trading with scared money. Trading with scared money is very, very tough to get through, because now you're afraid to take trades that you're going to get full stop outs, and it's going to affect your judgment and where you get in and out. All right, any questions on risk management? I didn't want to spend too much time on that, but I wanted to address and speak to the question, the issue of nominal to smaller sized accounts. This issue of how many contracts do I put on, 1 or 2? What instruments should I be looking at? I think this addresses that, right? And then it's all correlated to your experience level and the size of your account driving your entries. I see a question from David. Question here, David saying, let's suppose hypothetically that we did not get in the trade at 6:30 at support when it opened, and let me see here, and would you have boxed, assuming that you boxed it in, would it appear resistance, no bias, had gone either way, back down to support in the general trend? Okay, in fact, that's a great question, David, and let me put it out there like this. Let me blow this up and push. I'm gonna, if we're all don't want to get more distracted on this, I'll just push this over here. Everybody's clear about risk, yes? There's no more questions on that. I'm gonna blow this up so we get real clear about what's happening at the open, because a lot of people get wigged out at the open. Okay, if you're one of these people who get all freaked out at the open, we get this all the time. I've heard this a million times, and how many people are here like this? You know, Charles, 6:30 comes along. I'm just so nervous. I'm so nervous. You know, I put my lines on the charts. I'm managing my risk. I'm only going to do 1 contract on NASDAQ or YM. I have 2 charts up. I'm very disciplined. I'm ready to take these trades. And then 6:30 comes along, and I just can't pull the trigger. I'm nervous. I'm sweaty. My palms are sweaty. My stomach's all tied in knots. I'm afraid I'm going to make the wrong move. It starts moving. I can't see anything. It's like a blur to me. I can't figure out what to do, even when I'm in the room. Well, if that is you, if we are describing you in this scenario, then is 6:30 in the first, say, couple of 5, 10 minutes, or even 15 minutes of trading, is this a time for you to be taking trades if that is you? If I just describe your situation, if I describe your situation about how you feel at the market open, is this a time when you should rightfully be taking trades? Yes or no? Probably not. Doug says, that was me and I don't trade that anymore. Good. Here, let me allay some fears, because this is what I hear all the time. You know, Charles, I'll tell you what, if I don't trade that open, I know what's going to happen. It's going to open, it's going to run 100 ticks, right? It's going to be the move of the day. It's going to run 80 ticks, and I'm going to miss it, and then I'm going to be upset with myself because I'm stuck with the chop, right? So I've got to get over this fear. I've got to take that trade at the open. I've got to take it. Now, come on. Let's back up a second. You have to tell me that within the next hour and a half, 2 hours, by 8 o'clock, we're not going to get another big move? Really? Realistically? So I'm trying to allay your fears by telling you that it's perfectly okay to not trade the first few minutes. Let the market come out. Let it move around a little bit. I know people who don't even come to their trade. They'll have everything set up. The charts will be up. They'll get their cup of coffee, whatever their prep thing is, and they're sitting there, and they sit on their hands until 6:45, 7 o'clock. They don't even look at a trade. It's the fear of missing out, Pervez, right? The fear of missing out versus the nervousness of trading the initial moves at the open. Okay, that's the trade-off we're talking about. And you have to psychologically sort through that. It's different for everybody in here tonight and listening on the recording. It's different. Some people are okay with it. Some people aren't. If you aren't, don't worry about it. There's going to be tons of moves come along. Just don't worry about it. Now, back to this other question. I missed the box at 6:30, and next thing you know, when I look at it, okay, I didn't box it. I missed it. Okay, I just missed it. Whatever. I didn't get filled here. I'm not long, and now we're up here. Now the question was, can you box this up here with no bias and let the trade unfold from here? You can. Okay. Or you could box it here with an upward bias. That's another option. If you decide not to take this because it is considered part of the thrust move, and you don't get in here and you don't box it in here, then what do we do when it does this? This thrust. What do we have to do if we miss the trade entries and the market has moved all the way up into here, into these fresh swing highs? What do we have to do? Tomorrow morning, you wake up, Friday morning, you're in the live trading room, you got a chart up, you're looking at it. It does exactly the same thing. It's in a range, it bounces, you miss it. It comes up here, you were going to box it, it sat here for a couple of minutes, you just didn't do it. You just missed it. Now the market's moving up here. You're convinced that it's an up trade. Should you take a long trade up here? Should you pull the trigger long up in here? It's going up. Could run another 40 ticks, maybe you miss it. Here, let's open this up. What do you think? Buy order right now, market buy right up here. Let's get in. Come on. Anybody with me? You're going to miss it, right? Didn't we say big moves, big moves? Here we are, 6:34, 4 minutes in. Let's get it. Let's take it. We're going to catch it. I know we are. No. You have to wait for the retracement. Good. There you go. Wait for it to come back to us. OJ, good. Pull back. Here, Doug says, well, most days my best trades are after 11 a.m. Today, my best trade on YM was around 2 p.m. set up perfectly. Yeah, there you go. You have to wait for the pullback. Okay, we are just so everybody we're kind of playing with the same deck here. The way markets move is you have this notion of thrust, which the market is pushing in a given direction, up or down. Thrust, that's the push. And then there's a retracement. Markets pull back. Right? They thrust and they pull back. They thrust and they pull back. They thrust. It's just that's the way price action works. All the scripts, the algorithms that the big banks run, all the discretionary traders all over the world. And so the point I'm trying to make with this, and this is really important for everybody to take away here, is we never, ever, ever buy or sell on thrust moves. This is a complete no-no. If you're in the habit of doing that, and we understand the psychology behind it, because here's what's happening is, you know, you wanted to get in down here, you wanted to get in up here, and by the time it gets up here, you are convinced that it's going up. You doubted it here. Okay, the bars were red and you were under the mid-band. You had your doubts. It was at the top of the range. You were thinking to yourself, I could box it here with a bias to the upside and a tight stop. You didn't do it. And now it gets up here and you're like, yo, this thing's running. You have to fight that temptation, because right as soon as you're getting in, the market's pulling right back to where your stop is, and you're going to get bipped with stops. Okay, Shervette, he has to take off. Hey, don't worry. I've seen people come in here late, and if you have to take off early, don't worry. Some of you came in late. We're going to make sure that this gets posted on the web. It's going to be in the members area and Gary's. If you haven't seen Gary's from last night, mine from tonight, the whole thing, start to finish. You can come back and watch the whole thing. Peter saying, in the case we got a pullback, how do you avoid buying? Hey, OJ, no problem. I know you came in late. It's not a big deal. Don't worry about it. We'll have it up on that webinar area. You can download it tomorrow morning. Okay? Yeah. All right. So here's our thrust. We're about 4 minutes into to this morning's trading session, and I'm gonna pull this back a little bit here. Now, based on this chart, and some of you have been around for a while, you've heard me say this probably 1,000 times, right? If and when this market is to retrace, where might it go to? I'll give you 10 seconds. This is how you train your subconscious and your trading psyche. And by the way, this is the exercise that Gary and I do. All right? When you're in the live room and you hear Gary or myself say something like, if it pulls back to such and such, I am going to do this. And this is an exercise that I would strongly urge everybody in here to practice at. Now, you're not having a crystal ball. You're not trying to predict the future. That's not what we're doing here. What we're doing is trying to be intelligent about positioning ourselves for a trade opportunity that could come in the future. Right? We're just not going to sit there and say, well, I don't know. I don't know, Charles. I mean, it could go anywhere. It could go way up there. It could come all the way back. I don't know. I don't know what to think. Now, is that a good way to trade? I mean, is that the way we trade in the room? No. You've got to have a little bit of forethought here. You've got to say to yourself, okay, now, logically this market could come back to here. And if it gets back to here, this is what I'm going to do. All right, I see some numbers coming in. Last swing, mid-band, 47.21 from Jacobo. Hey, Jacobo. 23 to 21, support, mid-band area from Peter Pavez at 23. All right, good. Now, when we visualize retracements, no, I'm not moving my cursor yet. I'm sitting right here. Cursor moving. Everybody see it? Back and forth down here. Cursor up and down. See the cursor? White arrow moving back and forth. Yes? You see it, David? We like to think of retracement areas as a sort of like a batting zone for a pitcher who's throwing a pitch at a batter, whether it be softball, baseball, doesn't matter, whatever your sport. Everybody likes to say the mid-band. We all want to say it coming back to the mid-band. And let me, for the sake of this exercise, put the predictors back on. Okay, when we say sweet spot of a batting zone, what are we talking about? Right? And this is really important. This is one of the up in the top 3 or 4. Instrument selection, proper risk management, sweet spot of retracement trades. This is right up there in number 3 or 4, right up, right here. We have a little zone, and I've come to visualize I can see these now kind of in my head. I don't really have to think about them too much anymore because I've done probably 10,000 of them, is that you could get a shallow retracement where the market comes not so deep, finds support, bounces, and heads up, right? We have an area that I would characterize as at or around the mid-band. This is kind of the middle of the sweet spot. Okay, this would be in pitching terms, getting one down the pike that's just ready, teed up, ready for a home run, right? Right in the middle, right perfectly there is teed up for you to swing at, ready to go. And then sort of the bottom of the range would be a little bit deeper retracement. Comes a little bit under the mid-band, finds support, and does what it's going to do. So mentally, when we're seeing after a thrust move and we are predicting and thinking about retracements, we have to position our mind in this manner. That it could have a shallow retracement in here. Mid-band, we really like, a little bit deeper. Let's look at some examples over here. Really quick before we play this out. How about this retracement? What do we think of that one in our little trading range? See it? That's a mid-band one, right? How about this retracement right here in this trading range? Another mid-band one. How about this one over here, the one that we talked about at 6:30? A little bit deeper. Still support, still an uptrend, but you're a little bit deeper. So aren't these some pretty good examples that fit into our notion of this sort of batting area, if you will, right here in terms of retracement? All right, let's go ahead and play this scenario out. Here's what happened. We double top up here right around our 28.25 area. We start to pull back. We pull back. We pull back. We pull back. And what happens to these bars right here? Where are those bars located? Excuse me. Let me take a sip of tea while you look at that. Stand by one second. Sorry about that. Well, what happened here, and I think everybody can clearly see this, is that by virtue of the fact that we had this thrust move up here with our little double top and we start to retrace, that the mid-band has actually moved up slightly into our more shallow retracement area in here. And that the bars came down and perfectly touched and wicked this area and then bounced up. So you had a bar close entry, you had a box entry, and you had a line entry long off the mid-band at the upper end of our sweet spot to buy and get long. Yes? There was a question earlier about what does the YM scalper target want to be. When I trade it, I usually put it, it's either going to be at 5 or 6 ticks. If there's another swing that's around there a little bit higher or lower, I'll adjust it. But as a good rule of thumb, you know, you're looking at about 5, 6 ticks. Sometimes it'll only go 4. Sometimes it'll bip up to 8. It's a function of how the market's trading and where the support and resistance levels are. That's a good point. There is a predictor right here. Let me, just for this, everybody sees the predictor here. For the sake of cleaning this up, let me take the predictors off, and I'm going to offer you several reasons. We had a support level, we have a swing level here, we have the mid-band, and it's the upper end of the sweet spot where we're looking to get long. This is a textbook long retracement bounce off of the mid-band at 6:34 Pacific this morning, and I think we called and took this trade. Top third of the strike zone, that's right. That's right. That's exactly what happened here, right in here. Okay, so let's advance the chart. We come up, we come up, we come up. And I remember calling these numbers out in the live room. Take some coin, take your... So when we say things of the nature of take your scalper coin, explicitly what we are saying is that the market has moved up. Looks to be about 8 ticks. Excuse me, I remember taking this trade. There's so many more trades I can't remember the details of it, but I know it hit the scalper target. came right back, held the top of the box, and usually it does that, right? I remember saying, okay, it's got to stay above that 24 right there, and it did. It came back, bounced, and went up and challenged the swing and took it out by 3 ticks. Remember? Anybody remember that? I'm remembering most of it. All right, there's your long trade. If you're in multiple contracts, multiples is defined as 2 or more. Now, you know, when a market's moving around early in the morning, it's not unusual for me to put 10, 14, 20 contracts on, just to let everybody know. You know, I'm not trading 1 or 2 anymore. I'm well beyond that. I'm putting generally on big moves, you know, I'm putting 10, 15, 20 contracts on. So when I say scalper, I'm probably peeling 5 or 10 off here, right? And then I'll tighten the stops. When I have big runs, I'll let 5 or 10 run. But we can scale that back and we can relate that to 1 or 2 because all we're talking about is just more leverage, right? The entry technique is no different. The exit technique with the scalper and taking money at resistance is all the same. It doesn't matter how many contracts you have on. All the trade management is exactly the same, right? So that is our goal as we think about into the future, is that once we get beyond a small to modest account and we get beyond 1 or 2 contracts, we build up our trading account a little bit, we can put on a little bit more leverage, and then we start to make a little bit more money because your win rate goes up. Okay, moving on. So we're topping out here around 637, 638. We're peaking out to a fresh swing. We come to 29.50. We're running our stops up. Our stops are running up, running up, running up. We come back. Now, a word about stops. And I don't want to run out of time and completely getting sucked up in these trades here, but I have to say this, is that stop management on these trades is as much science as it is art. There, you almost have to kind of develop a little bit of a feel for it. And that's when I say things like tight stops and loose stops. Tight stops generally are going to fall in this area right here. Can you see this little area between stealth and line 6? So if you're ever wondering, where in the heck is Charles coming up with these numbers? Why is Gary's calling out these levels? Why are we talking about stops at these levels? If you can train your eye to look around where the stealth is hovering and where line 6 is in an uptrend, that's generally where the stops are going to be hanging, right in this area right here. Okay, when you're getting a move, you can set up Object Trader to do this automatically. You don't have to manually do it, or you can manually do it, but they're going to be sitting somewhere right in here. On the short side, okay, if we were short, it's going to be sitting down in here somewhere, right around this line 2. So next time when you're looking at stop levels, if you're in trades or you're trading in sim and you're trying to sort of keep involved with that, you know, if you can train your eye to look for these areas right here, that's generally where your stops are going to be, on your tighter stops. Looser stops are going to be closer down around the midband. And we generally don't have the looser stops until you're in some kind of large, protracted, extended move where it's, let's say hypothetically it's moved 20, 30, 40 ticks and you're getting you're getting 15 tick pullbacks, and then it's running another 60 ticks. Now you're going to have to loosen things up a little bit, right? All right, so we get a little bit of another triple top here. We punch through it a little bit. We're trying to hang here. We get stopped out. It's meandering around. Now where do we think it's going to come back to? Arguably, at the open, we had 1, 2, 3 trades. We stopped out of the third trade right here. We're flat. And we're looking for a potential re-entry into NASDAQ. You got 12 seconds. Where would you take another trade if and when it was to get into or pull back to that area? Type in a number, however you want to look at it. Okay, we're hovering up here at 28. You got 8 seconds left. What are you going to do? You make the call, team. You're making a trade call here. Tomorrow morning. It's like a repeat. Tomorrow, let's say pretend Friday morning we get up. Here it is, 6:38 in the morning, 6:39. We've already had a couple of trades. Let's say you missed them. Your rule was you don't trade the first 5 minutes. You want to see what happens. Okay, now you're after 5, 10 minutes. Now you're looking for trades. What are you going to do? I can give you a hint. we're looking for a pullback. Okay, I'm going to give you a hint. Where is it going to pull back to? Where would we anticipate something to happen? Good, I see some numbers. Peter, Mark, Pervez, all weighing in, mid-band, predictors. Okay, let me put the predictors back up. Sorry about that. I just take those off sometimes. When I draw in here, it's a little easier to see where I'm drawing in, but I'll put the predictors back up for you. There you go. Actually, that is helping you, not looking at it. See some numbers here from Pat, Roger, Brent, and Jacobo. 47, 24, 23, 25, 22 from Byron. Most excellent. Okay, most excellent. Most of you are saying Chris weighing in 22 to 24. Good, I like that. Okay, here again, we're talking about the strike zone. Let's call it, you can use a different terminology. How about zone of opportunity? So in our mind's eye, what we're doing when we visualize our opportunity zone, I'll use that instead of the term strike zone, however you want to think about it, is the same as over here. Retracement's pretty much all the same as we visualize them, right? You have an upper area, you have a mid area, and you have a lower area. And we all know what those are defined as. So some of you typed in a retracement around the midband, some of you typed in numbers, some of you typed in a range. You know what? You're all right. Notice there's a couple of predictors sitting right in here. There's a midband right in here, and that's a good area where we're expecting a nice pullback. See, it's right kind of in the area of where we bounced last time. What I'm trying to do here, if I can, and I know I'm going really in detail through this, I'm trying to demystify the trades that you see set up. I know that some, especially if you're just visiting and seeing this for the first time, it might seem a little bit confusing to you, and it might be a little daunting because you see all these stuff on the charts, right? What I'm trying to show you is it's really not that complicated. It's only as complicated as you let it be. If you boil it all down and bake it down to what you're really looking at, it's not really that complicated. But the key, though, is to have consistency in how you look at it and how you trade it. Like one day you don't want to come in and just look at this thing willy-nilly and sort of make some bad judgment calls and not really plan or think ahead or think about your opportunity zone. Next thing you get whack-a-mole a couple of times, this doesn't work. No, it does work, but you have to be consistent in the way you apply your thinking. All right, so let's forward it over. Let's go on. Let's see what happens. Okay, we're dinking around up here. We already stopped out. We're flat. We're not going to buy it up here, right? It's still up in the upper part of the thrust zone. We got stopped out. We're done. Okay, we're waiting. It's got to pull back. We're not buying up here. It's that simple. Okay? Okay, we pull back, and now the bars are sitting right here. What is that? What do these bars represent right here? You've got 1, 2, 3, 4, arguably part of 5 bars sitting. Where are they sitting right now? Here. Tell you what, I'll advance a little bit more. I'll do a little more for you. I'll give you a couple more bars. That'll help you out. Where are all these bars sitting? Right here. Yellow bars. Where's my cursor? Right here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Sat there for about a minute and a half, almost 2 minutes. They're sitting right, oscillating right on the midband. And I would say arguably in the sweet spot of the sweet spot opportunity zone, right in the middle of it. I mean, I don't think it gets any closer to a midband trade than that. Huh? It doesn't get any closer. Now, second part of the question. This is a two-part question for the team here tonight, okay? We all see that a box is forming right in the center of our sweet spot. We all see it, right? At 6:42 in the morning, do we have an upward bias, U, downward bias, D, or do we apply no bias to this box, which would be N for no bias, or NB, no bias? U for up, meaning that you go into Object Trader and you allow it to take longs only. Down, or S for short, where you allow it to take only shorts. Or let's do this, B for both. In other words, you go ahead and you box this with Object Trader and you allow the market to trade either way, up or down. Up or L for long, just type in a letter. What are you going to do tomorrow morning? Same box sets up on NASI. You're trading YM and a box sets up just like that at 6:45 tomorrow morning. What are you going to do? L, long only. S, short only. B, allow it to trade both sides. Ooh, mixed reaction here. We got some NBs coming in from Doug and Mark, and a couple other Bs from, wow, a lot of Bs. Okay, Roger, Tom, Pat, Mark, Minaj. Hey, Minaj. Byron going long, Jacobo going long. There's quite a few longs. There's a few longs in here. Peter, let's see, Brent, Roger, the both. All right, for me personally, this early in the morning, and I get this question all the time, and this comes up in the live room all the time. There are really two choices here, okay? First of all, let me get rid of one of the three choices. Let me just get rid of one, which we know is not the right answer. Short only is not the right answer, and nobody typed that in, okay? So we know that's off the table. So you're left with either up, long, or both. In the case of those who said up, long only, that's a good answer, okay? And I would not rule that out. If you said that the trend is up, I'm just going to type in an L here. I should just put this long in so you see it. And I understand the reasoning. Everybody in here tonight understands the reasoning of why you would say that, right? Because granted we're going sideways here, but the background is green, the bars are blue, arguably the mid-band and all the bands are stair-stepping up. The trend is up to sideways, right? And so it's perfectly fair for you to say, you know, Charles, I really just want to take longs here because I see we're at support and I'm looking for a bounce. I want to get long here. And that is a good answer, absolutely. Now, for those of you that said both, the only thing overriding the long-only scenario is the time of day that you're trading. It is quite possible that this could eventually roll down here and start to change trends, given how early it is in the morning. We did have news at 7 o'clock. I think it was ISM, right? And sometimes they leak those numbers, and sometimes you can let the market trade both ways. In this scenario here, what happened was if you said both, you were filled short right over in here. Somewhere on one of these bars, either this bar right here or this bar right here. Now, let me ask this question. For those of you that selected long only, stand by 1 second, please. I've got to get this line out of the way. It's just sitting right in the way. Just give me a second here. I'm sorry. I'm getting a little issues with my little chart here. Okay, I really want to talk about this rollover here. So I'm going to get some of this stuff out of the way because it's going to just confuse what you're looking at here. So let's get all this stuff out of here. There. Okay, good. All right. So for those of you who took the long only, when you noticed this right here, what could you have done? I'm going to draw it like this. See the best way to do. So let's try to see the best way to do this. There. Now it took, you know, this box over here started painting at 640, 641, and it dinked around in here for at least 2 minutes, and then it took another 2 to 3 minutes for these bars to form right here. What I'm saying is there was a little bit of time here. It wasn't like nanoseconds where it was just there for like a second or two and it just flipped and you didn't know what to do. When you had this box drawn and you were not filled long and you noticed that the bottom was broken, you didn't enable shorts, but you noticed that it came up and started hitting the midband and started to roll, what could you have done here? You long only. I'm speaking to the long onlys. The boths we know. The boths we know. You were in. You're already short. We know that. For those of you that set up only, if you'd only checked the long box, when you started to see this kind of price action, what might have you done? Take the market short. Good. Wait for a pullback. Look for a roll off the mid-band. Go ahead and take the short. Good. Yes. Yes. So we have to be very astute, okay? Especially in the first half an hour. Now, generally speaking, after 7 o'clock, especially on a news day, the market kind of gets into a groove. So the scripts are all working out. You know, traders are kind of in sync, and you don't get this herky-jerky stuff, although sometimes you do. Sometimes 7:30 to 8, it turns into just a sideways, choppy mess. But yeah, even those of you who didn't activate the short side on your OT box here had an opportunity to get in on the roll. Now, if you missed that short completely, box, rollover, whatever it is, you just didn't get it. And the market comes down all the way into here. Okay, I'm running over tonight. I'm going to go another couple of 5 minutes because I really want to play the rest of this out. Here's your thrust. You missed it. You got to wait for a pullback. We all know that's how we handle thrusts, right? We don't chase it. Where might it pull back to get short? We know we're in a downtrend now. The background's red. We're stair-stepping down. Stealth is in there red. Broken all sort of support levels are all taken out to the downside. We're looking for a rollover short. Cursor's right here. Cursor's right here. Cursor's not going anywhere. I'm not showing the cursor. I'm asking you a question. Where are you getting short? That's what you should be looking at. Where are you going to get short? We're waiting for a retracement. If you don't do this exercise, I would strongly see if you could do market replay and or do it in live markets in sim, but try to visualize this over and over and over again. It's like muscle memory. You got to try to get your mind to remember what to do. Yes, good. I see line 2. Good. Good. We got to think of a sweet spot. What's our sweet spot? What are we going to do? Yeah, you know, where's our opportunity zone come in? Up in here, right? Might come back a little bit. Might come back up into here. Let's play it out. What's it doing here? In here. What's it doing? What's it doing right up in there? Coming to the lower end of the sweet spot. I see some numbers coming in. Jacobo, Byron, Chris, Roger, excellent. Line 2. Peter, Pervez, yes. Yeah, you're looking for a rollover. It drops down, dropping down, pulling back. Fresh low, fresh low. Double bottoming. What about here? Anybody tell me what this is? I remembered calling this one out. In fact, as I recall, I was stopped out of this trade somewhere in here like this. It came through line 6. It closed above that 713.50, stopped me out, came right back to the midband, and what is setting up right there? Box it. Midband short setup. Good. Okay, now you're at 657. We're going into news. Now, with this move down like this, right into the news, you could go either bias or bias to the short side. That would be your two choices there. The trend is down. Short bias on the box. You're looking for a bar rollover. You're looking to get short. You want the bars to roll down through this midband to get you short again because our stops were taken out right here. Everybody see that? By the way, everybody following along here, any questions? I see everybody really typing in some good answers tonight, so it seems like you're really getting a good sense and a feel for what this is doing here. Okay, we roll over, we get the short entry. I remember taking this trade. Get a scalp target, put some contracts on here, get down to a fresh swing low. We start tracking it, and it stops out, keeps going right down here. It pulls back and takes us out right there. Last question, and then we're going to wrap. What are we trying to accomplish every morning when we trade? Is it to take as many trades as you can? Look for as good entries as you possibly can? Try to catch every trade? We go into the morning, what's in this back of our minds? What are we trying to do? What are we trying to accomplish every morning when we trade? This is the last question. I'm going to turn the recorder off and we're done. Oops, hold on. Let me stand by. No, it's not make money. Well, make money is part of it. Stay green. Okay, good. Not have to find a day job. Okay. This is few and done. Good. I'm looking for one word here. What would it be? Looking for one word. Here, let me put it. I'm sorry. Let me make it 2 words. But I'm going to make it in caps so everybody remembers it. We all should have a profit goal for the day, and our sole purpose of trading is to hit this. It's not to try to find as many trades as we can. It's not to try to see how many trades we can catch. Staying green is important and not losing money. That's all important. It's all part of the grand scheme of things. But our sole purpose is this right here. We want to get our goal. Do you have a goal? Get the goal and go into sim. Protect our capital. If you don't have a goal, you're trading blind. Everybody trading these markets should have a profit goal. This is part of the discipline thing I talked about at the very outset of this webinar. If you don't have a profit goal, straight up, you might not like to hear it, you're not disciplined. Okay? It's not a big deal. You can fix it. You can have a profit goal. You've got to have a profit goal. This tells you when to stop. Right? How many times have you been in a room? You guys visit the room. You guys and gals, everybody visits the room, right? And, 20 minutes in, 15, 35 minutes in. And some of you do it here. Some of you here tonight say this. Bam, I hit my profit goal. I'm done. Heading out to breakfast. Thanks, guys. See you tomorrow morning. We're not making this stuff up. Twice my profit goal. Thanks, guys. Have a good one. I got to go. Right? Hit my profit goal. I'm going into sim. Thanks, guys. I mean, we're not like making this stuff up. These are live people in the room taking these trades and hitting their profit goals. It's quite possible you could have put 2 contracts on any one of these trades I just showed you in this lengthy explanation of trades. You could have put a couple contracts on any one of these and had a very modest goal of a couple of $500, and you would have hit it very easily. You would have been done by 7 o'clock. You don't care what happens after that. You are done. This is what you want to do. Have the discipline to have a goal and try to hit it every day. That's how you make it long term in this business. If you don't apply this, if you don't think about the instrument, you don't manage your risk properly with stops, if you don't visualize these trade setups at or around the mid-band like we're talking about here, you're sort of willy-nilly throwing your contracts to the wind. You don't have a profit goal. You're not certain what your stop out max loss is. You're not applying discipline, and your odds of lasting long term in the trading game are vastly diminished. Okay? Please make sure that you apply discipline to your trading, because that's how you're going to make money in the long term. Thanks for coming, everybody.